Welcome to Part 3 of Module 2's videos. This one is on the Qualified Business Income Deduction. So the QBI deduction is not well covered in our textbook anywhere. So I've posted a good article that you can read on this, I think from Fortune magazine, but to be honest, can't remember. But it explains it as well. So if you get lost in the video, there's some hope that you could go read the article and have a better understanding than I can provide. Okay. In any event, the QBI deduction is something that started as part of the Tax Cuts and Job Act, Tax Cuts and Job Act of 2017. So it's effective for tax years 2018 and forward. And it's a mess, right? So here's a cool flow chart. This is provided by a small firm that you can use that kind of explains how it works in case my explanation doesn't get it done. So you might hear this called the Pass-Through Deduction, the 199 Qbi Deduction. It all means the same thing. So we know that this is a below the line. So that means it's after adjusted gross income. So a from adjusted gross income deduction for non-corporate taxpayers. And it's available to taxpayers who take the standard deduction as well. So meaning even if you don't itemize, you can still take the QBI deduction. Generally speaking, the deduction is 20% of a taxpayer's qualified business income from a partnership, S corporation, or sole proprietorship. So all those are flow-through entities. So it's 20% of the qualified business income from flow-throughs. So what is qualified business income? It's the net amount of qualified items of income, gain, deduction, and loss related to any qualified trade or business of the taxpayer in the U.S. So foreign income is not considered as part of the QBI deduction. QBI does not include the following. So it doesn't include short-term capital gain, short-term capital loss, long-term capital gain, long-term capital loss. So none of the capital gains and losses are in there. It doesn't include any dividend income, and it doesn't include any interest income unless that is properly allocable to the trade or business. It doesn't include any commodity transaction income or foreign currency gains and losses. It doesn't include any gains, deductions, losses related to notional principal contracts, which are derivatives. It doesn't include amounts received from an annuity, and it doesn't include any deduction or loss allocable to any amounts described in the preceding items. Okay, so a limitation that applies to all taxpayers is that the QBI deduction cannot exceed 20% of the taxpayer's taxable income, excluding any net capital gains. So Alice operates a small accounting business. It generates $60,000 of qualified business income. She also operates a separate investment advising business that focuses on providing cryptocurrency investment advice. That actually lost $20,000. Both of Alice's businesses are sole proprietorships, and Alice is, for the sake of the example purposes, is a single taxpayer. So Alice would first compute her tentative QBI deduction as $8,000. That's the $60,000 of QBI from her accounting business, less the $20,000 loss from her cryptocurrency advice business. So that's a net of $40,000 times 20%, or $8,000. So in addition to this information, Alice also earned $5,000 in net capital gains. But she had no other forms of income, and she elects the standard deduction. So in 2018, Alice's taxable income that is subject to the 20% limit for QBI purposes is $28,000. That's her $40,000 of business income, less her standard deduction of $12,000. And recall that capital gains would be excluded from this taxable income calculation. So as a result, Alice's QBI deduction is going to be limited. Her taxable income is $28,000 times 20% is only $5,600. $5,600 being less than that tentative deduction of $8,000 that we previously calculated. So she will report or recognize a QBI deduction of $5,600. Okay, I wish it was as simple as that, but naturally it isn't. Sorry, I'm taking a little drink here. And so we need to press on with some of the complexities. So there are two additional limitations. One is called the wage limitation, or the wage and capital limitation. And the second one I describe as the specified service business limitation. Okay, so these additional limitations apply to taxpayers, only to taxpayers that have taxable income, that's total taxable income, not just business income, above the threshold amounts, which in 2018 is $315,000 for married filing joint and $157,500 for all other taxpayers. So these threshold amounts are in fact indexed for inflation starting in 2019. Okay, so let's start with the wage and capital limit. So the wage and capital limit is actually two different items, and you get to pick the greater of the two. The first is 50% of the allocable share of W-2 wages with respect to the business, or 25% of the allocable share of W-2 wages, plus 2.5% of the unadjusted basis of all qualified property. So for that, we need to know what are W-2 wages and what is qualified property. Well, W-2 wages are pretty straightforward. Those are wages that are reported on Form W-2 to your employees. Qualified property is a little bit more difficult. So if the depreciation period for property ended in any prior tax year, that property is not included in the calculation of qualified tangible property. So the depreciation period is defined as starting when the property was placed in service and ending on the later of 10 years or the last day in the last year of the property's regular depreciation. And that's not to consider alternative depreciation systems, whether they are elected or not. Okay, so let's scroll back and look at this calculation again for a second, right? So the W-2 wages, that's pretty straightforward. You just take a strict percent. This unadjusted basis of qualified property. So the unadjusted basis implies that it is the cost value, right? So we do not reduce it for any depreciation expense. And to be qualified, the property has to be within its depreciation period. That depreciation period ends on the later of 10 years or the last day in the last year of the property's regular depreciation. Okay, so Josh is a single taxpayer. He operates a sole proprietorship. He qualifies for QBI, and his taxable income subjects him to the wage and capital limitation. So Josh has purchased and placed in service property, all of which are currently being used in 2018, which is also a requirement. So in 2007, he purchased a 5-year asset. So you'd have to ask yourself, okay, is it still in its regular depreciable life? And if you did any depreciation in 332, because we're not going to do any in here, you would know that in fact, no, after 6 years, its regular depreciation is done. And so it will have ended by 2018. So that is not qualified property. However, a 39-year asset placed in service in 2007, that is still being depreciated. So that's within its active depreciation period, regular depreciation period, and as a result, that is qualified property. A 7-year asset placed in service in 2009. Well, in spite of the fact that it is past its regular depreciation period, because it's been, we're in our 9th year, that is still qualified property because it is, remember, the greater of the regular depreciation period, or 10 years. We are still within the 10 years, and as a result, that is qualified property. And thus, the 2012 asset, same situation. Even though its regular depreciation is done, it is within the 10-year period, and as a result, qualified property. Okay, so the QBI deduction is subject to a phase-out, right? So just because your income exceeds these certain amounts, it doesn't mean you lose your ability to take the QBI deduction. Instead, what happens is it phases out. So that happens over $100,000 for married filing jointly, $50,000 for all other. So if the phase-out starts at $315,000, it ends at $415,000 for married filing jointly. So hopefully you've done some phase outs before. We will do some more later on in the course. So don't worry, you will definitely get a chance to become an expert at phase outs. But typically phase outs are some percentage or dollar amount is taken away as the measure of interest exceeds some threshold. So in this case, as the taxable income would exceed $315, some percentage is taken away. This one actually works a little bit different and uniquely because the QBI deduction phase out works as a with and without computation. So let's roll through an example of the QBI deduction phase out. So first, you would compute the QBI deduction as if there was no wage limitation. Then you compute the QBI deduction, including the wage limitation. You measure the excess of the QBI deduction with no limitation over the QBI deduction with a limitation. You call that the excess amount. And then the excess amount is subject to a pro rata phase out based on how much the taxpayer's income exceeds that threshold amount. So Phil is a single taxpayer with QBI eligible small business. It's not a service business. And his taxable income as measured for the QBI deduction is $177,500 and therefore exceeds the $157,500 for a single taxpayer by $20,000. Phil's QBI is $150,000. His business paid wages of $42,018 and it had qualified property of $660,000. Okay. Let's go through those steps we just described. So step one, what is Phil's QBI deduction with no limitation? Well, recall his QBI is $150,000, so times 20% is $30,000. So next we calculate it with the limitations. So we would take the greater of either the 50% wage or the 25% wage and capital limitation. So if it paid W-2 wages of $42,000, 50% is $21,000. And $42,000 times 25% plus his $660,000 of qualified property times 2.5% yields $27,000. And so the greater of those two amounts is $27,000. So his QBI with limitation is $27,000. The excess amount is $3,000. That's the amount with no limitation less the amount with limitation. Now we measure how far he is over the threshold. We'll recall he's $20,000 over the threshold. The threshold phases out for a single taxpayer over a $50,000 window. So he is 20 over 50 or 40% of the way there. As a result, 40% of his excess amount is phased out. 40% of $3,000 is $1,200. As a result, of the $3,000, $1,200 is phased out. That leaves, in my mind, $1,800 if I did my math right. $1,800 plus $27,000 is $28,800. That is his QBI deduction. Wasn't that glorious? So, for taxpayers with income in excess of the threshold, certain types of businesses are also not eligible for the QBI deduction. So that's a taxpayer whose business is being an employee. So think of this as if LeBron James decided to incorporate himself kind of thing. So he said, my business is being LeBron James, and that's what I do. So that's not eligible for a QBI, or if it's a specified service, trade, or business. So specified service, trade, or businesses are, and I'll just let you read this. Okay, so you can see they're the typical service businesses. Now, a service business is not precluded from the QBI deduction, but it is phased out, very similar to the previous one. Remember, if your income exceeded that amount, you didn't lose the QBI. It was phased out as your income increased in excess over those thresholds. So, before we do this example, let me state emphatically that I will not hold you responsible for a double phase out, which is what I call this situation. So I'm presenting it as an example so you can see how it works, but I will never make you do this on an exam. It's just too darn complicated, and frankly, the software will take care of it. Okay, so Jenny and Jason filed jointly in 2018. Jenny's a physician, works for a wholly owned S-Corp that has QBI of $310,000 in 2018. The S-Corp paid Jenny wages of $80,000 and her employee wages are $40,000. So we know that it pays W-2 wages of $120,000. So Jason earns wages from his job as a school bus driver of $40,000. So Jenny and Jason's taxable income before any QBI deduction is $385,000. And Jenny's business has qualified property at the end of 2018 of $300,000. So we can see that Jenny and Jason's taxable income creates a problem. On top of that, Jenny's a physician. And so her S-Corp is a medical business, which is a service business. So we are going to run amok because we cross over into a service business. So let's see how you do it. So first you would calculate Jenny's QBI deduction without any limitation. So that would be her $310,000 of QBI income times 20%, which is simply $62,000. However, Jenny and Jason exceed the threshold income by $70,000. That's their $385,000 of taxable income minus the threshold of $315,000. And they're involved in a service business. So as a result, they are going to be subject to a 70% phase out under the with and without method. Alternatively, they are eligible for 30% of the deduction under the limits, right? So if 70 is phased out, they get to keep 30. Now, how did we come up with 70? Well, they're married filing joint. They're $70,000 in excess of the threshold. Recall that the phase out occurs over $100,000. So the $70,000 over the $100,000 is the 70%. So first we calculate QBI at 30% because that's the only amount she's entitled to take. So remember, QBI was 310. We multiply that by 30%. That's $93,000. Now again, let's remind ourselves, what is the 30% from? This is not the same as the 20%. The 30% is the amount of the deduction that she is eligible for because her taxable income exceeds the threshold. So we would do the same thing with the W-2 wages. Recall her business paid W-2 wages of $120,000. She has to also prorate that at $30,000 and bring it down to $36,000. Her qualified property is subject to the same pro rata share of only 30% or $90,000. So now we can calculate Jenny's tentative QBI deduction under the general rules. So 20% of QBI, which is the $93,000, that's the 30% she gets, is only $18,600. Now we would apply the W-2 and capital limits as well. So, or the greater of W-2 wages times 50%, that's the $36,000 times 50%, or $18,000. Or 25% of the wages plus $90,000 times 2.5. So you might think to yourself, Jenny's QBI deduction is $18,000, right? But you would be incorrect. And I guess I haven't put it in here. The W-2 wages at 25% plus 2.5% is only $11,250. There it is. I did put it in here. So that's a much smaller number. So the larger is the 18, and that's the one we would focus on. So you can see without is 18,600. With limitations, 18. So you might think to yourself, her QBI deduction is 18, right? Because we already did the 30% phase out, but that is not how it works. Because recall, that phase out was related to the service business. Her QBI deduction with no phase out, 18,600. Her QBI deduction with the phase out is 18. That's in excess of 600, which is also subject to the phase out. So recall, she phased out 70%, or you could say she keeps 30%. 600 times 70% is 420. So that means her QBI deduction is left at 180. So she takes 18,000 plus the 180. All right, that brings us to the end of Module 2. Hooray! So I'm looking forward to working through some of this stuff in class, and good luck on the quiz.